Hello, everyone. Welcome. Excited to be here with all of you and to talk about rental property investing. Before we dive in, I just want to quickly introduce our speakers today. And to start, I'm Ryan. I'm one of the co-founders and the CEO of Arrived. Ownership of homes has been really a passion of mine for over a decade, and thankful to be here with all of you today. Jake is our head of investor relations. If you have any questions, please submit them through the chat feature on Zoom. Jake will be responding to you live, and then we'll also share some of the questions that come up at the end and talk through that. And then third is Cameron. Cameron's our VP of investments, has a wealth of knowledge on single-family home investing, and is going to share more about how Arrive works and how to get started for anyone who's interested. To start, we have a great agenda for today. I'm going to share some of the benefits to investing in real estate overall, the different ways to invest in real estate, and then do a quick introduction to Arrived. And then Cameron is going to take over and get into some of the specifics on how the Arrive model works, the benefits that Arrive can offer to investors, and really how to get started from there. And after that, we'll take any questions from the audience and break after that. So let's start with some of the benefits to investing in real estate in general. One of the reasons investors have really long seen real estate as an important part of overall investment portfolios is really due to the fact that you can earn money in multiple ways. And with real estate, you can really make money in four ways. Two of those ways are cash that you're kind of receiving in your hands, and two of them are really more related to tax advantages. So to start, you're getting rental income from operating the property, and then you're accessing property appreciation as property values grow. On the tax advantages side, you get the tax advantage of depreciation, which can basically increase your cash flow. And it's essentially the ability to offset a phantom expense of property depreciation against your rental income. And then the last is the tax advantages of long-term capital gains when you sell the property. Next, real estate has really seen strong historical returns. The two line charts you're seeing here from the Federal Reserve Bank. The top chart shows the median home prices for the US over time, and the bottom chart is around rental rates over time. And when we look at the 10-year total returns for the S&P 500 versus something like Vanguard's real estate ETF, the returns have exceeded the S&P 500 over the last 10 years through 2019. And of course, this is just historical data. No one can predict the future, but in the past, just that ability to make money in multiple ways from real estate has really also partly contributed to that consistent growth over time. The next reason that investors are often looking to real estate is really based on overall portfolio diversification. And this ties into modern portfolio theory, but essentially the simple concept that for risk-averse investors, a well-diversified portfolio can maximize returns based on a given level of risk. And real estate as an asset class has historically had a lower correlation to the stock market, and as a result is often recommended as a complement to other types of assets. And finally, real estate provides access to low-cost leverage. Leverage or debt can act as an increase on your purchasing power beyond just the cash that you have available today. And as a result, can magnify your potential returns, whether up or down, depending on how your investment performs. And real estate has long had the lowest cost of leverage because it's just a tangible asset that holds a lot of resale value on the overall in the market. And so with that, how do you invest in real estate today? And first, there's several types of real estate assets. There's commercial, which includes retail establishments, office buildings, medical buildings, and schools, things that you see around your community. Then there's industrial, like warehouses or factories, residential, like single-family homes or multifamily buildings, and then vacant land. And in terms of how you access those real estate investments, you can buy property directly, where you go through the full process of searching the market, submitting offers, and taking on a mortgage, and then managing the property. or you can invest through REITs or real estate investment trusts and public funds. The most common REITs are publicly traded, and you can buy shares through your brokerage account of choice. And REITs offer great tax benefits without needing to manage any of the underlying properties themselves. But since they're often publicly traded, they tend to be more correlated to the stock market performance, and their prices can be a bit more volatile than the actual underlying real estate values. And then the third is this kind of new generation of real estate investing platforms. And there's great companies here like Fundrise and Realty Mogul that focus on properties like apartment buildings or office buildings. And then companies we love like Ground Floor, which make it easy to invest in real estate debt. Instead of owning equity in the house, you actually get to act as the bank. And finally, Arrived also fits here. And our focus is specifically around empowering people to own individual homes. And overall, I'd say I'm personally really passionate about accessing residential houses, which of course led to creating Arrived in this product. But I think that homes can essentially be a great way to start your real estate investing journey. We're seeing a lot of strong growth in single family rental market and in homes in general because of this really shortage of inventory and desire for flexibility that people have, where more people are kind of looking to rent in. And overall, we've just seen single family homes to be such a strong asset class that can really be a cornerstone of a healthy financial portfolio. From a market perspective, new home construction has not been able to keep up with demand for houses over the last 10 to 15 years. And that's part of what's contributing to these continued home price growth. But despite the benefits of investing in houses, in the past, the process of investing in properties has been really hard to get into. I mean, it's complex, uncertain, time consuming, and mostly offline. And our vision for Arrived is really to change this forever so that we can make ownership of homes easy and accessible for everyone. And so really Arrived is a platform for investing in equity shares of individual rental houses, starting from just $100. Through our website, investors can browse available homes, reserve shares, or select the homes they like, and invest online by connecting their bank account. And then they start earning passive income from rent and potential appreciation as property values grow. It's an exciting innovation in investing in rental houses that we're thankful to kind of be sharing with all of you. And with that, I'll hand it over to Cameron to share a bit more details on how Arrived works.
Thanks, Ryan. And thanks for everybody for joining us today. So I'm going to talk about how it works kind of internally, how we select our markets, our homes, and get it to a cash flowing state. Then I'm going to talk about some of the benefits of the platform in investing with Arrive. Then we're going to go into how to get started. So, you can buy your first shares of your rental homes. So, on the internal side, we start top down and we look at neighborhoods and markets. And there's a couple different dynamics that we look at. So we're picking MSAs, metropolitan statistic areas that have a lot of population growth. So population growth is really the kind of fundamental driver of real estate value. The more people you get in a city, the more demand there is for real estate, and both property values and rents tend to go up. And over the last 10 years, since the single family rental industry has really started exploding, we're shifting more into a rentership economy. At least we're seeing that in the kind of residential housing area. So, we look for the high population growth. We look for areas with good fundamental economies. People have to have higher wages to support the rents and the assets that we're getting into. And we're picking areas with great neighborhoods, great schools, just really good long-term investments. Because the value in real estate is that it tends to be the best value in assets because there's a strong demand for it. They're very liquid in the sense that there's a lot of participants in the market. So, we're looking for all these, the right blend of attributes that will make it a long-term investment for you to hold. Second, buy the right home. So once we have identified those markets and those neighborhoods, we go into analysis of the home. So we're looking at the full market every single day in all the markets that we operate in. And our buy box is pretty specific. So, a little bit about rentals. Traditionally, they are not the highest quality single family residential that is there. They've tended to be lower grade. They've been seen as investment properties secondary to somebody's primary residence. So they haven't gotten quite the capital investment and the love and attention that really good quality houses get. And we're looking to change that. So our asset buy box really focuses on newer assets, new build qualities, better construction, so that they will hold up. They won't have a lot of capital expenditures, and they are in those great neighborhoods that can make premium rents. So most of our assets are newer, and we're even committing to a lot of new build purchases. So it's really special in the rental market because, as I said, a lot of markets are underserved in the sense that people are looking for high quality housing, but there's just no good options. So our asset strategy really focuses on filling in that gap where we can get premium rents. And we've found a lot of success so far in offering those premium homes. So there's slight improvements that we do to it also. There's some conventional wisdom that we follow within the rental industry. So for example, I'll just give you one example of that. When we buy homes, we replace the carpet and put in a material called LVP. It's luxury vinyl plank. And it's better for rentals and it looks great because if you have carpet in there, a lot of families, they have young kids, they have pets. So carpet is a recurring expense for the investor in the rental home. So we just want to do away with that, make a smart cap investment in the beginning, and then we benefits for that for a long time. Have carpet cleaning. We don't replace it. It's a durable material that really stands to the rental experience, and it's a little bit more expensive, but not really. So we just make a lot of smart decisions like that to try to improve the cash for the investor. On the cash flowing renting, so we go for longer term leases. We
A little frozen.
Oh. I'll take over for Cameron while he's getting reconnected. Oh.
Sorry about that. Was my audio cutting out?
Yeah. We can hear you now.
Okay. So we go for longer term tenancies with our homes, and we believe that strong occupancy is really the key. We're getting consistent rent growth as well, but we really favor longer term occupancy for maximum cash flow. And we really try to find the right tenants, and operating at a higher price point also allows us to kind of filter for a lot of the higher quality tenants with better credit and better income. And it just offers better returns for the investors. Kind of the final step in our process is to wrap it all up in a package that is very easily investable for investors on the platform. So we put every asset into an LLC, and then you own shares of those LLCs. So you're a true owner of that property. And then, going forward with the cash flow, you are entitled to all the dividends and the appreciation of that investment. So on the next slide, some of the benefits of investing with Arrive. Okay, so passive income. This is a truly passive investment that you're making with Arrive. You get the dividend income and you get the appreciation. So you really don't have to do anything once you commit to purchasing the shares. Capital appreciation. So over the long run, single family residential has been the best appreciating asset in our country. And you're entitled to all of that appreciation as the beneficial owner of that. So, that's really where the payoff is. So staying in the asset for a long term, the dividend income is great and you're getting a lot of good cash returns, but you're really in it for the appreciation. So no liability debt. This is a really cool feature that we think is a pretty good value proposition for a lot of people. So, traditionally with real estate investments, you want to lever it up because you get to magnify the returns. So you put, X dollars in, and then that leverage with the debt helps magnify those returns. So the problem though is that you've always had to put your credit at risk, and you've always had to have sufficient credit to even get the loan in the first place. So with the Arrived model, we get the loan on behalf of the LLC that owns the property, and it's non-recourse, which means that there is no liability to the investor. So, if imagine the worst case scenario that, the markets are crashing and things like that, there's no liability for the investor. So, we're bullish on the market, and we don't really foresee the same kind of events that led up to the Great Recession. But with that said, there is no liability debt for the investor. It doesn't impact your credit, and you don't need to have the credit to get into it. No operational responsibility. So, kind of related to the passive income slide, this is really big because real estate, there's a lot of steps in it. So from identifying the property to underwriting it, to forming the business entity to put into it, getting debt, finding tenants, leasing it up, performing maintenance, filing tax returns, keeping track of all the accounting expenses. There's a lot of operational steps that go into making real estate. And it's one of the big hurdles to get over for an individual investor. So with Arrived, you have that operational responsibility. And we also make taxes really easy. So at the end of the year, you get a single consolidated statement in all of your investments. And then that gets filed. And it can be filed with a very simple return, like the 1040 easy. A lot of people don't file more complicated taxes. And we structured it such that the tax filing associated with our investments can be done in the simplest manner. And that goes to tax advantages. So we are structured similarly as a REIT in the sense that you get a lot of tax deferred cash flow payments. So that's been always one of the biggest benefits of investing in rental real estate. You get to take the depreciation and the expenses against the rental income. So the traditional owner of a rental property would get that cash flow, that rent net of all the expenses, and not have to owe taxes on it in the current year until they recapture the point on the sale. Similar here, that a lot of your returns will be tax deferred payments that will be recaptured at the end, but you're getting the cash flow without having to pay all of the tax burden up front. Low minimum investment. So each one of our homes you could buy into for as little as $100. And we really see it as the cost of diversification, as like a good selling point for diversification. Traditionally you would have to put all of your eggs in a basket, so to speak, and invest in one rental home, two rental homes, et cetera. But with our platform, if you have $200, you could put $100 into each home, and then you're now diversified across two assets. So that kind of immunizes you against certain risks. And it also allows you to do things such as invest in a home that has a higher cash return, but a little bit less growth potential, and then put the other investment into something that returns a little bit less cash year on year, but has really great growth potential, like a Seattle home or a home in San Francisco or Austin, Texas. And that, really was kind of a 2-in-1 statement about diversification, right? We want our investors to spread out their investment dollars across multiple properties, and we think it's the prudent thing to do. So we're selecting the best properties that we can in the markets that we're in, and we encourage you to do the same, to diversify for as little as $100. Flexibility. So, I kind of talked about this in two dimensions. So our model is very flexible because we can scale across markets very quickly. So we started out in Northwest Arkansas in a really fundamentally sound town of Fayetteville, Bentonville, MSA. It's where Walmart's headquartered. It's where the University of Arkansas is. And it's been a great investment. And traditionally with real estate, you have to kind of get a lot of homes in the same market to scale, where you get kind of benefits of reduced operating costs, et cetera. And we've kind of flipped the model on its head. So our model is constructed such that we can target a lot of different markets, a lot of different MSAs, really across the whole country. There's no limit on where we can invest. No regulatory limits, no tax limits, nothing like that. So, we plan to be all over the country, and we can do it quickly. So we pass that flexibility to our investors. So, we're already in a couple of different markets, and we have a lot more coming at the end of the year. So, really synergizes well with the diversification and the assets that we're buying. So, again, we encourage you to invest all over the country because that would be the best way to get a lot of good diversified exposure to single family residential. Next, getting started, viewing properties, selecting the investment amount. We really made it a simple process, and we think it's extremely important to have a very great user experience. So I can kind of describe it in a couple steps. So you come onto our site, you provide some basic information that you would have to with any investment platform, they're called KYC rules, know your customer. So it's kind of standard identification information and connecting a bank account. So we make it really easy to connect your bank account. And if you can't do it digitally, we have backup options as well to help facilitate that. Really only takes a couple minutes. And once you do that, you're ready to go on the platform. So you select the properties that you want, you can view them, we take great photos of them and provide good information about the asset as well as the market. Then you select the investment amount with $100 being a minimum, each share representing $10, so a 10 share minimum on each property. And basically you check the box with the terms of service, look them up, and then you buy now. So once you do add it to your cart, then you effectively have a agreement to look over, read the documents, check it out. You e-sign it, and then once you've e-signed and funded, you're an investor, you're an owner at that point. So we've reduced a really complicated process of, what would normally take months to finalize from the time that you identify the property, down to about 4 to 5 minutes. So it's a great experience for the users, and we've got a lot of good feedback from users saying how easy it is. And that's our goal, is to make it the simplest transaction possible, and then find you the highest quality real estate that we can. That really goes into the next slide, fund and start collecting rental income as well as appreciation. So at that point, we pay out quarterly dividends on the cash flow from the rental income. And at that point, you just start collecting your money, and then we provide some portfolio analytics and are constantly adding to our product offering to give you better insight into your portfolio and the properties that you're investing in. So, at a high level, that's what we do internally. Those are some of the benefits that we see with the Arrive platform and how you can get started. So at this point, we'll take some questions and answers. Take questions and hopefully provide you good answers.
All right, nice job, Cameron. So the first question we've got here is, what is the hold period on each property, and what is the criteria on which you guys will sell it?
Yeah, so the hold period is anticipated to be 5 to 7 years. So on that front, real estate is a long-term investment. So we anticipate a longer hold period to at least realize a lot of the appreciation. Sometimes real estate can be volatile in the short term, whether it be to the upside or to the downside. So like in the last year, we've seen really strong property appreciation across the entire country. Historically, there's not a precedent for this kind of run-up. And as far as the criteria on selling it, maybe what I would first start with is when we would not sell it. So we would never sell it going into a down market. And the reason is this: as rental investments, there is always a cash flowing mechanism to this. So a lot of the payoff is in the appreciation. So we don't want our investors to have a negative experience with, not capturing that appreciation. So in the event that the market were to see a downturn, we're going to continue to operating as rental, passing on the cash flow to you, and then kind of biding our time, waiting for an inevitable recovery for the single family residential assets. And once that happens, then we're constantly monitoring and evaluating the property values. So I would say that we're also very opportunistic about our markets. So we can go into a lot of markets very quickly, and just as easily we can pull out of them. So if we see that a market, let's say, gets some bad news, a major employer in the area is planning on moving out of the area. So what we could do is cash out of those assets and then reallocate that capital and find better investments in other markets. Because markets are not homogenous. Some markets are going up while they're going down. Sometimes they all uniformly go up, like what we've seen recently, but that's usually not the case. So we're going to just look at really sound, fundamental, bottom-up information on the asset itself And if we feel like there's just a better allocation of capital in a more holistic sense, then we'll sell the asset, make sure that our investors are capturing the appreciation, and then recommend reallocating funds to a different market that we have more conviction on.
Here's a good question. Due to COVID, both the federal government and state governments have put into place eviction moratoriums. While the current situation continues to evolve, there seems to be a precedent with governments taking these actions. How does that impact our investment analysis and decisions on investments?
Yeah, that's a really great question that the industry is trying to figure out right now. And I would say that makes it even more that makes it even more relevant why Arrived is a great solution. So if you invest in your own rental property, you are subject to that risk, just as the entire industry is. So nobody is immunized from this risk of an eviction moratorium or kind of landlords having to kind of foot the bill during a temporary circumstance. And if you have all of your eggs in one or two baskets, a single tenant that is not paying because of something like that is a huge risk factor. So that's why we recommend to diversify across a lot of assets, so you are immunized against that risk. Now, we do everything that we can on the front end to make sure we're getting high quality tenants, that we are getting assets that are in desirable areas where you will have a tenant base such that they have better income, they have better credit, more reserves, et cetera. But inevitably, on a large enough scale, you do run into those issues. So I would say the best hedge against that is diversifying across all of our assets for your own portfolio.
This question's come up a lot in a couple different phrasings. Do you need to hold your investment for the full 5 to 7 year investment period, or is there a way to liquidate or trade your shares?
As
Brian,
Cameron
do you want to take
mentioned,
that?
yeah, I can take that one. And yeah, as Cameron mentioned, we're really designed for holding investments for the long term over that 5 to 7 year period. That said, we understand that things come up and people might want to liquidate or sell their shares sooner than that period. So what we have in place today is that after an initial 6-month hold period, investors can request to sell those shares, and they'll be posted or published to other Arrived investors who are interested in buying shares. We have a Help Center article about this that also include links on how to indicate interest on either side. And our plan is that we will invest in building more of a marketplace and allowing this to happen on a more proactive basis on various trading windows. That's not in place today. Today, it's more on an ongoing basis, ad hoc, as certain investors would like to request to sell after that initial hold period.
Next up, we've got a couple of variations of the question of, I reserve shares. What happens next? When do I fund the investment and start earning income?
Yeah, so I can take this one as well, because there's two components, and it goes back to how Arrived operates. So this is a very new investment class that we've created working with the U.S. Securities and Exchange Commission. And so we have an administrative function where after we go under contract with properties, we add those properties to our offering circular that's published on the SEC's website and is reviewed. Once we finish that period, that's when we allow investors to invest. And by that point, we should have been under contract with the property and kind of prepared it and readied it for investment. I'd say in the short term, our hope is to not even go through a reservation phase. We're kind of working on that dynamic now. But as soon as we get through that administrative kind of process with each property today, that's when you're able to buy shares. And what we end up doing is once we reach that point, we will send an email out to everyone who's reserved shares in those properties with a link that essentially allows you to very quickly kind of convert those shares or that reservation into a purchase. So you would add your bank account through Arrived, and that is how you'll end up funding the purchase at that time. And then in the future, that's the same account that we're currently will pay the quarterly dividends to as well. And so adding your bank account kind of serves that dual purpose also.
Also, a bunch of variations on this question of what kind of returns are you guys seeing in the market, or what kind of returns can I expect from my arrived investment?
Yeah, so we see markets right now and kind of bucket them into certain categories. Markets that we're looking at and kind of how we break them down might sit in some markets provide higher cash flow, some markets may provide higher appreciation, and other markets kind of offer a balance between the two. We are preparing our first dividend payment coming up actually in July, just here in a few weeks. And after that point, for our existing properties that we've sold that we're paying dividends on, you'll be able to see that historical dividend payment and the historical kind of expected going forward yield or dividend percent. Cameron, anything that you would add to that?
Yeah, if there's a lot of precedent out there of how the single family rental industry works from a financial point of view. So there are a lot of large public REITs that are high quality, such as Invitation Homes, American Homes for Rent. So if you check out some of their financial filings, it gives you an idea of what the industry is like. Our assets are a little bit different. Our business model is a little bit different. So we're not saying that it's exactly going to be the same, but to get a ballpark idea of what the industry looks like, I would encourage you to take a look at some of those public-facing single-family residential REITs for guidance on what the model looks like.
All right. Up next, two variations of the question. How are you different from your competitors like CrowdStreet or Fundrise? And why hasn't this been done before?
Yeah, I can start here, and Cameron, feel free to jump in. So Arrived is really focused on giving investors access to the ownership experience of single family rentals. That's really what we feel like has been missing. And it's such a phenomenal asset class over the history of real estate investment in America. And there's a lot of factors right now that are continuing to drive this single family market, where we are way undersupply in terms of new development of homes. We have a lot of economic indicators around more people shifting to renting single family homes at scale. And you have a lot of different types of buyers buying into single family homes, like these institutional buyers like Invitation Homes and American Homes for Rent. We want to give all investors kind of equal access to investing in this asset class. And really what we're trying to do with the Arrived investment is give investors the opportunity to be as close to the asset as possible, as close to the underlying homes or cities that they want to participate in, and directly benefit from being close to that asset by earning the direct rental income after expenses and the direct property value growth over time.
Yeah, and a little bit on why hasn't this been done before. Single family rentals is a really difficult business. There's a lot of logistics involved. Every asset is homogeneous, so it's different than an apartment building where you have a lot of homogeneity on the same street corner. So it wasn't really until the last decade that the model has even been proven out in the first place. Now, it's always been a great investment for anybody who's been able to get into it, but access has been the problem, right? So with better improvements in technology, we've been able to, and also the regulatory framework that allows for this, it hasn't really been until the last couple years that a model like this has even been able to exist. There's a piece of legislation starting in 2012 and continuing and modified in 2016 called the Jobs Act that allowed a lot of, the government allowed a lot more investment from non-accredited investors. So, the average American has a lot more options today as to what they can get into. So I think that is really why this model has not existed before in the past. Now, there's been variations of it, but typically it's only been available to accredited investors or, the extremely wealthy. And that's kind of the conviction behind this business, is that we should be providing this asset class that's such a great one to everybody. But there are a lot of good reasons why it hasn't been done before, but we're really confident going forward that this is going to become a mainstream, a big portion of everybody's kind of financial cornerstone.
General questions about our financing. How much debt do you use? Who's your lender? How do you get good rates? And what is the risk to investors?
Yeah, so we worked really hard to put together the best financing program for investors, and we disclose the amount of financing and the rates of that financing on each individual property page. So if you go to arrivedhomes.com and you click on Browse Properties and you look at individual properties, you'll see more information about the leverage tied to each individual property. The other thing I'll say here that I think we've mentioned before, but that we're excited to offer to investors, is the fact that the mortgages on our properties are non-recourse back to individual investors, meaning that there's no personal guarantees or personal liability on behalf of investors in Arrive rental properties, which I think is very unique in the ability to access rental homes without having to put your personal balance sheet on the line to invest.
Okay. What is the liability in general with Arrived properties? Do investors have any management say or concerns?
Yeah. So Arrive really acts as the manager. Investors have liability protection in that each property is held by a limited liability company. And so really using that to protect investors from any type of loss, like liability related to, let's say, a tenant or something that were to happen to the property. We also have a number of different types of insurance policies around homeowners insurance and umbrella policies. All of our renters have renters insurance. And those things are also additional levels of protection for investors' investments in the homes themselves.
And I'd also really quickly add to that, investors are protected from each other as well. So with Arrived being the management authority, there's no major stakeholder investor that would be able to, say, take action against other investors. So you are protected from each other as well, in a sense, not only assets from other assets, but investors from other investors as well.
We've got, do you recommend making one big investment or spreading it out over a bunch of different homes?
Yeah. So we don't really, with Arrived, we've kind of structured the product in a way that investors can kind of choose their own path. And so with Arrived, you can either do larger investments in individual homes, or because of the smaller investment minimum, it really does allow that broad diversification where you could invest in multiple homes over time and kind of diversify over time, which might be considered dollar cost averaging. And you can, of course, diversify across different types of markets. And so, we really want to, with our the investment minimums, create the opportunity to do that if that lines up with your own investment goals and kind of how you're thinking about investing in real estate.
General question here about our legal structure. If we could just talk a little bit more about Reg A Plus and the Series LLC structure and what investors are actually buying.
Sure. So with Arrived, we are an exempt public offering under Regulation A Plus, with registered with the SEC. And so we have qualified offerings for each of our homes. And that also means that we are reporting financial statements publicly to the SEC, just like other public reporting companies. We do audited annual financial statements for our whole portfolio as well. And really that's about investor protection. And from our end, transparency and disclosure. In terms of our overall structure, we are structured as a Series LLC, which is a somewhat new structure or entity structure, and really kind of primarily or originally designed for real estate, but it allows the creation of individual LLC segments without having to take on the cost of filing every individual LLC. And so when investors invest, they're buying shares in an individual LLC segment that owns that specific property. And so that gives them right to the underlying kind of economic future of that property, whether through cash flow from rent or through property value growth that can be captured when the property is sold or an investor sells their shares.
Let's see. What are your next markets going to be?
Yeah, so we've expanded into the Carolinas, and there are a lot of great markets in there. So, we haven't finished tapping out of those. Some of the ones that we want to get into still are Raleigh-Durham. It's a really high quality market, a lot of great educational institutions. And Apple even announced recently that they have a $1 billion campus coming to the Research Triangle area, which is kind of at the nexus of where all of the great universities are. Duke, Wake Forest, UNC Chapel Hill, all really high quality institutions. Really, we have a lot of options, but what's on our radar right now upcoming, we're looking for markets that are not as competitive right now. So some of the markets that have been overly saturated kind of look like Atlanta, Dallas, and those are all great markets with really strong economies that we're eventually going to get into. But what we're targeting right now is where there's opportunity. So a city that comes to mind is Huntsville, Alabama. So it's the second largest MSA, or it's the second largest FBI analyst community there, next to the city in Virginia, where basically the FBI is located. So there's also a big NASA expansion going on there. So those are the types of cities that we're looking to get into, is traditionally tier 2, tier 3, but really have a great growth trajectory going forward. So there's, Alabama's one of those places. There's a lot of good cities in the Midwest and Southeast Atlantic coast that we're also looking to get into. Nashville's been really great, and it's not kind of overly saturated yet. So the exciting, I could go on about markets, but I think the takeaway here is that we're going to have a flurry of markets coming up soon to help you diversify into all the best product in the markets that are really up and coming, as well as the established markets as well. So we can expand at a rapid pace, and I would constantly check back on our platform for the cities that we're expanding into, because it's going to be a lot coming up. So stay tuned.
Oh, Jake, I think you're muted.
I think I've gotten through all of our questions, but here we go. Here's one. What does the financing amount mean for investors? The part of the house that is in equity?
Correct. Yeah. So the financing amount is the portion of the purchase and offering that isn't funded by investor equity. So the other side of that, which I think you'll see as listed as the raise amount on our properties, is the total equity that's invested by investors in the offering.
Do we have any other questions coming in? Or if I missed you in the chat, please respond and let me know. Ryan, you want to talk through the lag on available properties and the reservation and SEC qualification process briefly?
Sure. Yeah, and I think this kind of goes back to something we touched on previously. Essentially, with the regulatory structure that we've created, we have an administrative process where when we go under contract with a property, we register it under our overall offering circular. And then once that update is requalified, then we allow investors to invest in those shares. And so we're working now to do that on our latest pool of new homes. And then as soon as that is ready, we'll invite investors to come fund their reservations or invest in the new homes that we have as part of that.
Surprised this one didn't come up earlier. Do I need to be accredited in order to invest?
Yeah, so that's really, I think, part of the innovation and structure that we've created and through our registration with the SEC is that anyone, including non-accredited investors, can invest in properties. And so no, you don't have to be an accredited investor to invest through REG.
All right. Any other questions coming in? There's another one. Why do some of the properties have 600 investors? Does it mean we'll all get shares? I can talk about this briefly. We have a bunch of properties that we're going to be posting shortly, but we have kind of market pages right now where investors are basically kind of saying how much they're interested in investing in each of those markets. And by doing so, those investors will get first dibs on our next property in those markets. So those ones don't have a capped amount of how much people are allowed to reserve. And so that's why there's so many more investors in those market pages than there are in the rest of the actual property. Arrives fee structure. Ryan, you want to talk through the two different types of fees that we have and where people can find more information about them?
Sure. Yeah, there's a offering details section on each property page as well, down toward just before the reviews. But you can see there the different fees for Arrived, and there's two really. One is a sourcing or a proceeds fee to Arrive related to, it's a one-time fee related to us facilitating acquiring the home, readying it for investment, including managing any renovation process, and really orchestrating the transaction. And so you'll see that listed as a one-time fee. And then we also have a asset management fee, which is equal to 1% of the equity per year. And that gets paid out of the operating income or operating expense for the property. So funded from future rental income. And so there's no additional kind of money that gets paid by investors out of pocket. Really, your initial investment covers both of those fees. And then oftentimes we'll get asked if there's any fee for property management. And today we partner with property managers, and there is a fee for or a cost for property management that's equal to, on average right now, 8% of rent. And that fee or cost really covers our property management partners for managing the day-to-day of the property.
Cameron, here's one for you. What's the timeline to scale out to 20 plus markets? Can you talk a little bit about our kind of horizontal philosophy in acquisitions and markets?
Yeah, so for 20 plus markets. So right now we are in 6 markets, and to get 14 more, it wouldn't really take much time. So I hesitate to give you a date because we want to be measured about where we're going and what we're doing. But what I can say is that we are able to scale much more quickly than your traditional real estate operating companies. So, if you really had to force my hand on an estimate of 20 markets, I would say by springtime, next, possibly summertime. And it really is going to be a function of listening to our investor base and, you guys helping us understand what is it that you're looking for? What are the areas that you're interested in investing in? We have our own thesis about where to go in terms of population growth and solid economic fundamentals and kind of the dynamics of the supply coming online. But with that said, we're also planning to be everywhere. So to the extent that you have strong convictions and want to start a dialogue with us about recommending places to go, we're always open to that and can make it happen pretty quickly.
That relates to Jason's question here. Can you give more detail on how you scale faster than traditional real estate companies?
Yeah. So the traditional real estate companies, their model is to be profitable on economies of scale by reducing their operating costs. So, for example, American Homes for Rent, which is a company that I used to work with, they're the second largest single-family residential rental operator in the country, and they also own the homes. They needed about 600 homes to justify opening up a market because they would incur the full-time employee expense there. And that means that once they go into them, they're really committed because they build out a lot of infrastructure. So they have to be very careful about where they go and to make sure that a market is large enough to support it. So our model is different. So we partner and orchestrate with a lot of third-party resources to bring the best management capabilities as opposed to building it out vertically. So we pick a lot of technology-enabled operators, and there's so many new players coming into the prop tech, which means property technology, and fintech, which is financial technology, that allow this orchestration to get very close to the benefits and the economies of scale that the traditional operators have had. Now, here's where the real strong advantage is with our platform. We're able to go to the places where there is less competition. And when there's less competition, that means your purchase price can be better. And that also means that your rents can be better because there's not as saturated of a rental market. So if we're offering high quality homes at good purchase prices in areas that large institutional, Wall Street type competitors are not going, that's where we can really offer you the best investment experience and comparable investment advantages on the platform. So going to Fayetteville and Bentonville, Northwest Arkansas, there are no institutional players there. So we're getting properties at great prices and really strong rents because our inventory is great. So that's more of the strategic philosophy that we have, is to compete in all markets. So yes, we will be going to the larger markets because they're large and expensive for a reason. They've got great economies. They've got great population growth. People are going there. But the thing is, there's a lot of large players that are already there. But there's plenty of tier 2 and tier 3 cities. College towns comes to mind. There's a lot of great college towns, highly educated population with good incomes, but housing is, not great there. So we see that as a real opportunity for us to come in and offer investments in a Fayetteville, Arkansas, for example.
Jason's got a good follow-up question. With increased attention from companies such as KKR and Invesco and other large institutions deploying billions into the SFR space, do you see that as a disadvantage into the market?
A disadvantage to the, sorry, let me ask a clarifying question. Disadvantage in the sense of the end consumer, or disadvantage to arrived?
I think he means a disadvantage to arrived and arrived's investors. But Jason, correct me if I'm wrong.
Yeah, so as far as being at a disadvantage to investors, more competition does breed a better product and just a tougher market to operate in. With that said, residential real estate is the largest asset class in the entire country. It's $27 trillion, and rental real estate is a $4 trillion market, of which only about 2% is institutionally owned. And a lot of it is in concentrated areas. So like the Atlantas, the Dallases, the Houstons of the world, that represents a disproportionate amount of that 2%. So in Fayetteville, in Tuscaloosa, Alabama, there's zero institutional competition. So to the extent that there's still a lot of meat on the bone, there definitely is, but not all areas are homogeneously competitive. Some areas have a lot more competition. Other areas, it's not competitive at all. So, we still have a lot of opportunity to acquire really great assets in markets all over the place. So a $5 billion investment, maybe that you're referring to with, say, Invesco. I don't want to sound too highfalutin, but that is kind of a drop in the bucket in the total market of residential real estate.
Any other questions trickling in? We're getting close on time. We got time for one or two more if there's any others. Otherwise, I'll pass it back to Ryan to thank everybody and do a quick wrap up. What partnerships do you need locally versus prop tech firms that can work online, such as mortgage or title? Cameron, you want to talk a little bit about our third-party servicers and kind of the operational efficiencies that we can gain that way?
Yes. So, the two local resources that we currently rely on are property management companies as well as local brokerage that have expertise in markets. So on the property management side, it's traditionally a very local business, but that's changed a lot in the last 10 years because of software as a service and basically the cloud computing. So there are companies that we are partnering with that offer really great advantages from cost savings as well as kind of data insights into the management of our properties that people who started out 10, 15, 20 years ago, they didn't have those. So it still requires a local presence, but there's a better blend between decentralized management and that kind of boots on the ground necessity. The other component is brokerage. So we partner with the local kind of experts in real estate, not to bring us deals, but to help us have a second eye and vet our deals. So we build up a really strong underwriting platform, and we see that as a core competency in our business going forward. Own the data, make the decisions of what's best for our investors, and then work with those with those local brokers to say, hey, we want to make that this area is really as great as it seems on paper. Can you validate that our thesis on this property is correct? And they'll help us calibrate on price, negotiation tactics, and try to get the best price for the investor. So that's how we work with the local resources right now. But with the space evolving as quickly as it is, I would not be surprised to see a lot of evolution in even those two spaces going forward.
All right, Ryan, you want to close us out?
Yeah. Thanks everyone for joining us today. I really appreciate all the questions and you spending time with us. We're all just really excited to hear your feedback. So feel free to reach out at any time to the team as well. Would love to have you continue to invest with us, and we're excited to share the new markets and new properties that we have coming soon. Also keep an eye on our emails. We'll be doing more of these as well. So thanks again, everyone, for joining. And yeah, we'll see you in the future. Take care.
Thanks, everybody.